Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a future, and it's really not that far off.
Huh.
A world just grappling with this enormous hunger for electricity. It's being driven really relentlessly by the explosive growth of artificial intelligence. Data centers, the digital brains of our world, they're becoming these energy behemoths. They're projected to triple their global electricity demand by 2030.
Triple. That's staggering.
It really is. And this isn't just about, keeping the lights on anymore. It's about powering a really fundamental shift in our civilization.
Absolutely.
And in this, high-stakes environment, one company stands right at the intersection of electrifying and decarbonizing our world, GE Vernova.
Right. Born from that huge industrial legacy.
Exactly. Forged from GE, now facing this monumental task of building the energy infrastructure for tomorrow.
A massive undertaking.
So for you, our listener, the critical question we're digging into today is, it's profound. Is GE Vernova genuinely positioned to ride this huge AI-driven energy wave for decades to become this indispensable powerhouse?
Or are there risks? Could it falter?
Precisely. We're going to unpack whether this company is a solid foundational bet for your portfolio, or maybe if it presents more of a risky gamble. The company's core mission, leadership, and roots. So with this immense challenge of powering our AI future just looming large, how does a company like GE Vernova even start tackling it? At its heart, there's this ambition that frankly sounds incredibly bold.
To electrify and decarbonize the world. Yeah, it's a big one.
Is it just a slogan, though? Or is there a real substance behind this goal, delivering reliable, affordable, and sustainable electricity globally?
Well, think about this. GE Vernova already powers something like 30%, almost a third of global electricity today.
Wow. Okay.
That's through their existing gas turbines, their wind tech.
So their vision to lead the energy transition and generate, say, 25% of future global electricity.
Right.
It's not coming out of nowhere.
Right. They're starting from a position of strength. Exactly. It's a foundational giant aiming to build the next era from an already dominant position. They're arguably the invisible backbone of our electrified world, and they're actively trying to redesign it. The scale is just immense.
And it's not just about the external mission, is it? There's this internal culture they talk about, the GE Vernova way. How do they make that real for their teams?
Yeah, they've built this ethos around innovation, always keeping customers front and center, running really lean operations. Teamwork, accountability are big focuses. They even launched something interesting in 2023, this control room sustainability framework.
Okay, what's that about?
It's essentially a way to make sure every employee's daily actions are kind of aligned with their big decarbonization goals. Shows the mission isn't just, a poster on the wall.
It's embedded, woven into how they operate.
Exactly. From product design right through to project execution.
Now, steering a company with such a, essential mission requires a specific kind of leadership, experience, foresight, disciplined execution.
Absolutely. And at the helm, you've got CEO Scott Strazik. He brings over 2 decades of really invaluable experience directly from General Electric.
The parent company.
Right. His previous role leading the gas power business was pivotal. He knows the nuts and bolts of energy generation inside out.
Any specific examples of his impact?
Well, yeah. He was instrumental in securing the net zero Teesside power project over in the UK.
Ah, yes. That's a big one.
It's a groundbreaking initiative, not just another power plant. It's really a blueprint for low-carbon energy, using GE Vernova's gas turbines with carbon capture.
So that directly shows his strategic clout, driving these big future-focused projects.
Precisely.
And beyond the CEO, the broader executive team needs to be strong too, right? Especially the financial side.
Definitely. You've got CFO Kenneth Parks. He brings this robust background in financial discipline, really honed during his time at Comcast.
Okay, a different industry, but strong financial grounding.
And his efforts are already showing results. Q3 2024 EBITDA margins in the electrification segment, they jumped by 630 basis points.
Wow, that's a significant improvement. Shows real impact on efficiency.
It really does. Then there's Rachel Gonzalez, the general counsel. Her role is critical navigating these incredibly complex global regulatory environments. You can't operate globally without that expertise.
True.
And Stephen Voskuhl, the chief strategy officer, he's the one spearheading innovation in crucial areas, like those hydrogen-incompatible turbines we'll probably talk more about, fundamental to their long-term decarbonization plan.
So it's a well-rounded team, operational, financial, legal, strategic.
Exactly, a holistic approach.
And what about oversight? The board of directors in a company this size, that's critical.
Absolutely. The board strength is quite impressive. It's chaired by Stephen Angel, the former CEO of Lind. Highly respected, deep ties to the energy sector.
Okay, solid industry knowledge there.
And it includes other seasoned energy veterans, like Paula Reynolds. Her experience at BP directly informs their decarbonization strategy.
So practical, real-world experience guiding the long-term vision.
Precisely. This depth of leadership translates directly into how they manage that balancing act, delivering reliable power now while pushing for sustainable solutions for tomorrow.
How does that show up in practice?
Look at their R&D investment. They've put a substantial $2.5 billion into developing energy transition technologies in just the last few years.
That's serious money, not just tinkering.
No, it's a clear commitment to shaping the future of energy, proactively building the tools needed for the next generation of power.
It's also important to remember the context here. GE Vernova just spun off in April 2024. It's new as an independent entity, but its roots go way back to Thomas Edison.
Right, 19th century innovations, a long lineage.
But unlike a lot of tech giants today, there's no founder involved directly. It relies purely on professional management.
That's a key point. Scott Strazik is clearly capable, strong track record at GE, but he's steering this massive ship on a new course. It's a different dynamic than a founder-led firm.
How does that affect things potentially for investors?
Well, executive incentives, like they laid out in the 2024 proxy statement, they're tied directly to things like revenue growth and EBITDA margins.
Aligning leadership with investor returns.
Exactly. That's the design. But the absence of that, let's say, visionary founder or family-driven ethos means it relies entirely on professional management. Now, they're highly competent, no question, but that structure might, in some cases, limit the kind of, say, long-term exponential outperformance you sometimes see in founder-led companies where a single vision drives things for decades, maybe less swayed by quarterly pressures.
So a trade-off, professionalism versus perhaps that entrepreneurial fire.
Could be seen that way, yes.
Yeah.
A different model.
So building on that history, it officially formed in 2024. Combined GE's power, renewable energy, digital, energy financial services, all into one standalone company.
Headquartered in Cambridge, Massachusetts, hub of innovation.
And as we said, roots back to Edison's first power plant in 1882, a true pioneer. That 30% of global electricity they power today, it gives you that sense of scale, their foundational role.
And key milestones shaped where they are now. That 2015 acquisition of Alstom's power business, that was a huge deal.
Right. Massively expanded their gas turbine portfolio.
Solidified their market leadership.
Yeah.
And more recently, launching those hydrogen-capable turbines in 2023. That wasn't just an upgrade. It was strategically positioning for decarbonization, recognizing hydrogen's role.
Foundational investments enabling their current strategy.
Absolutely.
But it hasn't all been smooth sailing, has it? They've shown resilience, sure, but there have been hurdles.
Oh, definitely. Those reported offshore wind losses back in 2022. They highlighted the execution risks. Big, complex projects always carry challenges.
Still part of the landscape.
Yes. But even with those bumps, look at recent performance. Q3 2024 revenue grew 13% year over year to $9.1 billion.
Pretty healthy growth.
And that impressive $55 billion backlog, that signals really strong ongoing demand and gives them significant revenue visibility for years out.
Too.
The blueprint, how GE Vernova operates and earns.
Okay, let's get into the nuts and bolts for you, the investor. How does GE Vernova actually make money? It sounds complex.
At its core, it's actually quite understandable, even with the sophisticated tech. They design, they manufacture, and they service the essential equipment for power generation.
So, turbines, reactors.
Exactly. Gas turbines running on natural gas or hydrogen blends, nuclear reactors, hydro systems, steam tech. They're also big in wind onshore in those massive offshore turbines. And then there's the crucial piece, electrification.
What does that cover?
Everything from grid solutions, power conversion, the software to manage it all. You can really think of them as the foundation, the actual backbone of the electric grid.
Getting power from the plant to your home.
Reliably and efficiently. That's the goal.
Can you give an example of their technical edge, something specific?
Sure, let's talk high voltage direct current, HVDC. These systems are critical for grid efficiency, especially over long distances.
Why is that?
Think of HVDC like a superhighway for electricity. It moves massive amounts of power, say, from a huge offshore wind farm way out at sea, straight to a city center, but with much less energy loss along the way compared to traditional AC lines.
So more power gets where it needs to go, less waste.
Exactly. It's complex tech, but it means they're building the arteries of our future energy grid.
But here's the thing, while that's high-tech, high-value stuff, a huge chunk of their revenue comes from something simpler.
Which is?
Servicing all that equipment they've already installed, those long-term contracts to maintain turbines, for example.
The recurring revenue.
Precisely. It provides consistent, stable income that balances out the more lumpy, project-based revenue from building new things.
So what makes their approach distinct in this crowded energy space? Lots of companies are involved in renewables or power gen.
It's their unique ability to operate right at that intersection of reliability, sustainability, and just sheer scale. They are undisputed leaders in gas turbines, 7,000 installed globally.
That's a huge installed base. Massive. And they offer cutting-edge grid solutions, all driven by this clear push towards decarbonization. It's this multifaceted approach, providing the traditional backbone and the green solutions, that really sets them apart.
How does that play out versus competitors?
Well, many competitors focus solely on renewables, like Vestas, maybe just in wind. Or they might stick to traditional power generation, like Mitsubishi perhaps.
Right.
GE Vernova's diversified portfolio spans fossil fuels, renewables, and the digital layer to manage it all. That makes them a comprehensive partner.
Can you give a concrete example of that diversification advantage?
Sure, those H-class turbines again. They're powerful, efficient, but crucially, they can run on hydrogen blends.
The bridging strategy we mentioned.
Exactly. This is groundbreaking. It lets utilities transition smoothly, start on natural gas, gradually blend in more hydrogen as the green infrastructure develops.
So future-proofing their investment.
Precisely. It bridges traditional power and the green future without needing a full rip and replace. That's a massive strategic advantage in a world trying to decarbonize responsibly.
And how do they actually sell this stuff? Who are their customers?
It's a direct sales model. They work directly with the big players. Major utilities, national governments, large energy developers.
Not selling to individuals.
No. And the cornerstone isn't just selling the equipment. It's securing those extensive long-term service agreements and landing these large, complex project contracts, multi-year deals, building national infrastructure.
How do they support that global sales effort?
They have this extensive global network of manufacturing facilities. Take their new HVDC valve line in Stafford, UK, that directly supports scaling up production of those critical grid components.
So manufacturing where needed.
Right. And they leverage sophisticated digital platforms like GE Digital's grid orchestration software. These aren't just nice-to-haves. They actively help customers optimize energy flows, predict maintenance, manage complex grids more efficiently.
Does that show up in the numbers?
Yeah. Look at Q3 2024. Electrification orders up a strong 17% organically, driven primarily by those direct sales of essential grid equipment, often enhanced by the software layer.
You mentioned recurring revenue earlier. That's always attractive for investors. How predictable is GE Vernova's income?
Remarkably high predictability. A full 60% of their revenue comes from those long-term service contracts.
60%.
Covering that massive installed base, 57,000 wind turbines, 7,000 gas turbines globally. It's an enormous, stable foundation, almost like a subscription model for industrial power.
And what about future orders?
Adding to that stability is their formidable $55 billion backlog.
$55 billion, that's huge visibility.
It represents firm orders for future projects, includes a significant 9 gigawatts of new gas turbine contracts just from Q3 2024. That gives them clear revenue visibility through at least 2028.
So years of work already lined up.
Exactly. Now, you do have to acknowledge that project-based revenue, especially big offshore wind projects, can be more variable. We saw weaker wind orders expected for 2025.
So some lumps and bumps there.
Yes, but the mix generally balances that stability from services with the growth potential from new projects. It reduces overall financial volatility, a calculated blend.
Let's break down their main business segments. You mentioned 3.
Right. Power, wind, and electrification.
Okay, power.
That covers the foundational tech, gas, nuclear, hydro, steam. And that advanced H-class turbine we keep mentioning, it powers an incredible 25% of global electricity.
One turbine model, 25% of the world's power. Astounding.
It really is. Then there's wind, both onshore and those massive offshore turbines. Though, as we noted, offshore has faced some demand headwinds recently.
Okay. And electrification.
Critical grid solutions, power conversion systems, specialized software. Their HVDC systems are showing strong growth here, 17% order growth in Q3 24. highlights that robust demand for grid modernization.
How well are their new products fitting the market trends?
Really compelling alignment with decarbonization. Those hydrogen-ready turbines launched in 23. They're fundamentally designed for clean energy integration. Strong market fit in gas power and electrification.
Positioning them well for the future there.
Definitely. But gotta be balanced. The fit and demand have been weaker in offshore wind. That's a challenge they're managing within the broader portfolio.
What's their roadmap look like? What are they investing in for the future?
Clearly emphasizing future-focused areas. Heavy investment in hydrogen tech, exploring the potential of nuclear, small modular reactors, SMRs, and continuously innovating in grid modernization.
And this isn't just talk.
No, it's backed by consistent, substantial R&D spending. $0.2 billion in Q3 2024 alone. Shows a deep commitment to advancing their tech edge to meet tomorrow's energy needs. 3. The unbreakable core competitive advantages. GE Vernova operates in what's best described as an oligopoly, a market dominated by a few huge players.
Siemens Energy, Vestas, Mitsubishi, those kinds of names.
Exactly. And GE Vernova's position is robust, a commanding 25% share of global electricity generation capacity, built on that vast installed base, 7,000 gas turbines, 57,000 wind turbines.
And it's hard for others to break in.
Very high barriers to entry. The sheer capital needed is enormous. That naturally protects profitability to some extent, though, as we said, offshore wind faces intense pressure, especially from Chinese manufacturers.
Right. Price competition there.
And within that market, their sheer scale is a massive advantage. Huge economies of scale.
Meaning lower production costs.
Right. They can produce these complex turbines at a lower per unit cost because of their huge volumes. Their Greenville facility, for example, churns out 300 gas turbines a year.
Spreading the fixed costs.
Exactly. Makes them far more efficient than smaller competitors. It's about being efficiently big.
What about advantages beyond manufacturing? Digital.
But, yes, their grid software shows powerful network effects. As more utilities adopt their platforms, the value increases exponentially.
How so?
Because the interconnected data sharing across the network enhances efficiency and resilience for everyone on it. You see that in the electrification segment's $1.9 billion Q3 revenue growing adoption, increasing value.
You mentioned counterpositioning earlier. Can you unpack that a bit more?
Sure. It's their dual focus, providing both reliable traditional gas power and leading renewable solutions. This sets them apart from pure-play renewable firms like Vestas.
So they're not just betting on one horse.
Exactly. They're building the bridge. Those hydrogen-ready turbines, like a Teesside, uniquely position them across the entire energy transition market, bridging old and new. That versatility reduces risk and expands their market reach significantly.
And once a customer uses their equipment, is it hard to switch?
Incredibly high switching costs. Imagine a utility relying on a GE Vernova turbine, replacing it. Huge capital costs, maybe billions, plus massive downtime.
Which costs them even more.
A huge deterrent. Creates a powerful, enduring advantage.
And those service contracts add to that stickiness.
Absolutely. Those contracts covering 60% of revenue, they're like golden handcuffs. It's not just maintenance, it's a deep partnership. Optimizing performance, predicting issues, integrating new tech.
So decades-long relationships.
Exactly. Creates incredibly sticky relationships, ensures predictable recurring income for Vernova, and reliability for the utility.
What about the brand itself? It's new, but it carries the GE legacy.
Cannot be overstated. That 140-year GE legacy of trust, innovation, reliability, it confers immediate credibility, allows premium pricing for things like the H-class turbines,
And builds loyalty.
fosters exceptionally strong loyalty among utilities who prioritize reliability above almost everything else. Brand trust translates directly into sustained business.
What about unique assets they control?
Well, that installed base of 7,000 gas turbines, their proprietary HVDC tech. These are hard-to-replicate resources built over decades.
Physical assets.
And human assets. There are 76,800 employees, including top engineers and scientists. That's a huge talent pool, very difficult for competitors to match in breadth and depth.
How do they leverage that talent and scale internally?
That GE Vernova Way lean operating model they implemented in 2024, it's had a real impact. Led to a 5% cost reduction in the power segment.
Significant savings.
It's a disciplined process that competitors struggle to match, partly because of Vernova's scale. Working smarter.
And their technology itself. Is it genuinely better?
Their proprietary tech is cutting edge. H-class turbines, advanced HVDC systems, remarkably more efficient. HVDC can cut grid transmission losses by 30% compared to traditional AC.
It's a huge efficiency gain.
Massive. And these innovations are protected by patents, giving them a crucial technological edge that's hard to copy.
The timing of the spinoff in April 2024 seems almost perfect, coinciding with the AI energy demand surge.
Impeccable timing. It gave them an immediate, powerful tailwind. A deliberate strategic alignment of their focus on grid modernization and efficient gas turbines with most pressing market needs. A right place, right time scenario.
And they can move quickly, too.
Demonstrated remarkable agility. Rapid deployment of HVDC capacity in the UK in just 18 months. Shows they can execute faster than competitors often slowed by red tape or supply chain issues. Operational agility means faster revenue, and all this translates into financial strength. That $55 billion backlog, including 9 gigawatts of new gas turbine orders, provides unparalleled revenue visibility in a traditionally cyclical industry.
A huge buffer and a clear path forward.
A powerful indicator of sustained demand and a solid foundation for future earnings. 4. The horizon growth prospects and future resilience.
Okay, looking ahead, what's GE Vernova's growth strategy? How do they plan to expand?
It's multifaceted. Market penetration, expanding gas turbine services in existing markets. Market development, entering emerging markets like Africa where energy demand is booming. And product development, investing heavily in hydrogen and those nuclear SMRs.
And acquisitions have played a role, too.
Historically, yes. That 2015 Alstom deal was key in bolstering their portfolio.
What are some specific growth opportunities that look promising?
Extending HVDC systems in Europe is a big one. Grid upgrades there are projected to grow 10% annually. Huge modernization effort.
And the nuclear side?
The SMR market, projected to be a $50 billion global market by 2035. Immense upside potential if they can lead early.
But there are risks too, right?
Oh, absolutely. Those ongoing offshore wind losses, potential regulatory delays, especially in nuclear. It's high reward, but with inherent challenges.
How relevant are their products to that AI-driven energy demand we keep talking about?
Incredibly relevant. Their solutions serve utilities, governments, industrials, and crucially, major data centers. Their grid solutions are powering hyperscale data centers for the biggest tech giants.
So, directly plugging into that AI growth.
Right at the heart of it, making them an indispensable partner in the digital economy.
How big is the overall market they're playing in?
The total addressable market, or TAM, is massive, estimated $435 billion annually.
Wow. How does that break down?
Roughly $200 billion in power generation, $150 billion in renewables, $85 billion in electrification.
And their goal?
They aim to capture 10% of that by 2030, up from about 7% today. Significant potential for market share expansion and a growing critical market.
Can we summarize the key drivers fueling that growth?
Absolutely. First, that skyrocketing AI energy demand data centers needing 8% of global power by 2030, a direct tailwind.
Okay.
Second, global grid modernization, a massive $2 trillion investment needed by 2035. They're perfectly positioned. Third, accelerated growth in hydrogen and nuclear tech, projected 20% CAGR through 2030. And fourth, the consistent expansion of their crucial service contracts that stable 60% of revenue, providing a foundation for future growth. These drivers paint a powerful picture for long-term expansion. How do they protect themselves against shocks? Supply chain issues, for instance. They've strategically diversified their supply chain across Asia, Europe, the Americas, reduces reliance on any single region.
But what about dependencies? Rare earths for wind turbines?
That's a valid point. It does expose them to potential risks, particularly from China. Their mitigation strategy includes diversifying sourcing and investing in domestic production where possible, aiming for greater security.
And customer concentration. Are they too reliant on a few big clients?
Impressive customer diversity, actually.
Yeah.
Utilities, governments, industrial clients in over 100 countries. Crucially, no single customer is more than 10% of revenue.
So that stabilizes income.
Exactly. Makes them more resilient to individual market shifts or client issues. We saw that with the 17% electrification order growth in Q3 24 broad-based demand.
What about protecting their competitive advantages? Could they erode?
It's always a risk. Aggressive Chinese competitors, undercutting prices, SMR tech may be becoming commoditized eventually.
So how do they fight that?
Continued, substantial R&D investment, staying ahead technologically, maintaining their proprietary edge, developing the next generation of solutions before competitors catch up. It's a constant innovation race.
You mentioned anti-fragility earlier. How does that work? Thriving in chaos.
It's fascinating. Energy crises, like the post-2022 gas shortages. Paradoxically, they often boost demand for Vernova's reliable gas turbines as countries prioritize energy security.
Turning a negative into a positive.
And their lean operating model lets them improve margins even under stress, like the cost reductions in 2024. They can adapt and even benefit from volatility. Remarkable adaptability.
What about their long-term staying power, say out to 2040?
Secular trends strongly favor them. AI energy demand growing 8% annually isn't temporary. That $10 trillion global investment in decarbonization by 2050, that's a mega trend aligning perfectly with their mission.
So their core products remain critical.
Absolutely.
Right.
Gas turbines, HVDC systems, critical for data centers. We estimate an 80% probability of sustained relevance through 2040. Offshore wind losses are a concern, yes, but their stable service revenue and backlog provide resilience to weather segment downturns.
Okay, so despite the positive outlook, let's clearly outline the main risks investors need to watch.
Right. Offshore wind market saturation and pricing pressure, especially from China. Regulatory delays in complex nuclear projects, those can really impact timelines.
Those are the known risks. What about unknowns?
Well, known unknowns. Things like policy shifts, future deregulation impacting renewable incentives maybe. Hard to predict the impact.
And unknown unknowns.
Truly disruptive tech. Fusion energy maybe. Could theoretically make turbines obsolete way down the line, but that's a distant prospect. Still, important to acknowledge the possibility of true black swan events. V, the financial pulse and market sentiment. Let's look at the macro picture. Rising interest rates impact their $5 billion debt, right?
Increases servicing costs.
Yes, though their investment-grade rating helps keep borrowing costs relatively low. But persistently higher rates could still dampen customer spending on huge energy projects globally. Financing gets pricier.
And trade tensions, especially with China.
A tangible challenge threatens rare earth supplies for wind turbines, could lead to tariffs, increasing production costs. But Vernova's global footprint offers some flexibility to navigate these issues. Shift sourcing or production if needed.
Inflation, how does that hit them?
Squeezes margins, materials, labor, transport, all cost more. But they managed favorable pricing in 2024 that largely offset cost hikes, helping maintain that 5.3% EBITDA margin.
Interesting point about rising energy costs potentially boosting demand for efficiency.
It's exactly. Paradoxically, higher energy costs can incentivize investment in their efficient turbines and grid solutions as customers look to cut long-term operating expenses.
What about specific geopolitical risks? Emerging markets.
Yeah, 30% of orders come from emerging markets. Political stability, regulations can be less predictable there, and currency fluctuations always impact international revenue when converting back to dollars. Adds complexity. Okay, let's run through a quick snapshot of their current financial health. Key metrics.
Lay it out for us.
Q3 2024 revenue, $9.1 billion, up 13% year over year. Strong electrification growth at 24% organically.
Healthy top line, margins.
EBITDA margin 5.3%, up 200 basis points, shows cost discipline. Net income surge 102% to $514 million.
Rule of 40%, where do they stand?
They're at 18.3%, 13% growth plus 5.3% margin. Below the ideal 40%, suggesting priority on growth now, but lots of room for future profitability improvement.
Return on capital.
Estimated 8% ROIC. Efficient allocation, especially in high-demand areas like electrification. Liquidity looks solid with 1.2 current ratio. Debt to equity conservative at 0.4.
Cash flow.
Big improvement. $1 billion year-over-year jump in free cash flow. That supports the $1.25 quarterly dividend. Book value grew 10% since spinoff, mainly from retained earnings.
And those industry specifics.
That $55 billion backlog, 9 gigawatts of gas turbine orders. Key indicators of demand strength and future revenue.
How does this compare to their peers? Siemens Energy, Vestas.
Their 13% revenue growth beats Siemens Energy's 10%, but lags Vistracor's 20%. And the 5.3% EBITDA margin, while improving, is still behind Vestas' 7%.
So room for improvement, especially in wind profitability.
Definitely an area they're focused on addressing through operational changes.
So the overall financial trends since the spinoff.
Steady revenue and cash flow growth, despite those persistent offshore wind losses. Improving margins, especially in electrification, and that growing backlog suggest a strengthening financial position overall, navigating challenges while building momentum.
What's the buzz among investors? Market sentiment.
Significant buzz lately. Q3 2024 earnings beat expectations. EPS, $1.73 visas, $1.48 estimated. That drove a big 42% stock surge in 6 months. Market confidence is high.
What should investors watch next?
The October 2025 earnings report will be key for clarity on the wind segment's recovery. Also, keep a close eye on progress with SMRs and HVDC expansion. Those are major long-term catalysts.
What are individual investors saying online?
Largely bullish. Lots of celebration around the 96% year-to-date stock gain, recognition of the AI demand tailwind. Smart comments, too, about global grid underinvestment positioning Vernova perfectly.
But any concerns being raised?
Oh, yes. The high valuation that 58x forward PE gets mentioned, and the ongoing challenges in offshore wind. But overall, the sentiment is overwhelmingly positive, fueled by optimism about the energy transition and Vernova's role. So at 6, the investment lens valuation and the verdict.
Okay, let's talk price. As of August 4, 2025, the stock's at $656.50. How do we think about value, that concept of margin of safety?
Yeah. Crucial concept. It's a discount between the market price and what we calculate as the intrinsic value. Minimizes downside risk by buying significantly below true worth.
What's a good margin for a company like this?
Ideally, for safety, you'd look for maybe a 20–30% discount for this type of established industrial player. Allows for bumps in the road. And why does valuation matter so much here, even with strong growth prospects?
Determines if it's overpriced, fair, or a bargain.
Right.
Guides the investment decision.
Exactly. Overpaying, even for a great company, risks losses if growth hiccups or sentiment shifts. Undervaluation offers upside. It's about disciplined decisions based on analysis, not just hype.
Okay, let's dissect the valuation. Intrinsic value first. DCF model.
Right. Discounted cash flow. Based on our assumptions, 10% free cash flow growth over 10 years, 3% terminal growth rate, 8% discount rate, our model yields an intrinsic value around $700 per share.
So based on future cash generation potential, it holds significant value.
Now, relative valuation comparing it peers, how does that look?
More nuanced here. That 58x forward PE is triple the industry average of about 17x. Clearly suggests the market has priced in a lot of future growth, premium valuation on that metric.
But other metrics.
Price to book at 5x is more aligned with peers like Siemens Energy. EBITDA at 30x is also high, reflecting those significant growth expectations.
Okay, let's build the bear case. The strongest arguments against investing now.
Right, the Steelman version. Institutional analysts like Mizuho downgraded to neutral, citing that stretched 58x PE, the ongoing offshore wind losses. Individual investors online also worry about valuation risk, competition from China undercutting prices, concerns about regulatory changes reducing renewable incentives, supply chain issues raising costs.
So the conclusion is,
if AI demand slows or nuclear projects stall, growth could falter. That could justify a 20–30% price correction down to the $460–525 range.
okay, now the Steelman bull thesis, the strongest case for investing.
Analysts projecting strong EPS for Q4 2025. That massive $55 billion backlog ensures growth through 2028. Investors praising accelerating EBITDA margins, 5.3%, robust gas turbine demand driven by AI,
The macro drivers.
AI energy needs, 8% CVGR, the $2 trillion global grid modernization, position Vernova as an indispensable leader. Plus, the huge potential from hydrogen and SMRs could unlock that $50 billion nuclear market.
Potential upside target.
The bull case could support a move towards $995, maybe a 50% upside if those innovations deliver and hurdles are cleared.
So weighing both, what's the most probable thesis?
The bull case seems more likely overall, given the backlog visibility, the undeniable AI demand, their tech edge.
But the caveat.
But that current high valuation definitely tempers the immediate upside. It's not a screaming bargain today. Prudence is needed.
So our final discount assessment, current price versus intrinsic value.
At $656.50, it's trading about 6% below our $700 intrinsic value estimate, only a modest margin of safety.
Fairly valued, maybe slightly undervalued based on DCF,
But that high PE warrants caution. Suggests much of the good news is already priced in. Outro.
So back to our central question. Is GE Vernova positioned to benefit long-term from the AI energy boom?
The bottom line.
Yes. Exceptionally well positioned. We'd estimate an 80% probability of sustained relevance through 2040. That backlog, the H-class turbines powering data centers, the HVDC systems for grids, the R&D in hydrogen and SMRs, it all aligns perfectly. They're architecting the energy revolution, not just participating.
But we have to acknowledge the challenges. Offshore wind losses, Chinese competition, regulatory shifts, rare earth reliance, the high valuation.
Absolutely. But their strength lies in how that diversified portfolio and their lean operating model mitigate these risks, makes them resilient, adaptable in a volatile landscape.
And those core competitive advantages remain strong.
Formidable moats, 7,000 gas turbines installed, proprietary HVDC tech, those sticky long-term service contracts, and that impeccable timing aligning with the AI boom. Powerful, sustainable advantages.
So let's distill this for you, the investor. 4 essential takeaways. 1.
Backlog visibility. That $55 billion provides clear revenue certainty through 2028.
2.
AI energy tailwind. Data center demand growing 8% annually directly benefits their core segments. A powerful long-term driver.
3.
Valuation caution. That 58x PE signals high optimism. Consider waiting for maybe a 20% correction for a better entry point, a bigger margin of safety.
On 4.
SMR potential. Nuclear small modular reactors could unlock a massive $50 billion market. Huge asymmetric upside if regulatory and tech hurdles are cleared. A key future growth avenue. So in conclusion, GE Vernova isn't just surviving the energy transition, it is actively shaping it. A compelling foundational investment for the future of global power.
Plan for the investor.
Strategically buying on dips, perhaps below that $600 mark, could let you capitalize on their pivotal role in powering the AI revolution, while carefully navigating the known volatilities within their portfolio.
As our world keeps digitizing, demanding ever more energy, just consider the profound implications of companies that not only meet this exploding demand, but also push relentlessly towards a more sustainable, reliable power future. What other foundational technologies will be essential to truly unlock the next wave of human innovation? And where might you find those hidden gems building the very fabric of tomorrow's electrified world?
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.